a bit weaker inbound travel to the U.S., a little bit weaker government travel. But the outlook for next year, for this year, 2026 is pretty good, 1% to 2% RevPAR growth.
That's revenue per available room.
Per available room, yep. And so leisure, group, luxury, all kind of strong. International, a little stronger than the U.S. But although this is an aging upcycle in the lodging industry, it's still got some legs to it.
Now, Hilton, along with many of the other hotel companies like Marriott, has an asset-light business model, which means that it's brand licensing, right? They don't actually own and manage any of their own properties. And that, allows it to move more nimbly. The profit margins are much higher. What's the downside of that, Brian?
So, there's some benefit to actually owning the real estate when you're really in an upcycle, but this kind of fee-based model is a very capital-efficient way to expand and grow. You get your franchise fees and management fees. They've got a little bit of owned hotel exposure as well, but most of the lodging companies separate from the REITs are actually asset-light manager franchisors with some owned assets.
Yeah, I'm looking at, you got a company with, $13 billion of revenue, call it, $4 billion of EBITDA, $100 million of CapEx. Are you kidding me? That is awesome. So who builds if Hilton wants to build a new hotel in South Beach, they don't build it, somebody else builds it?
Yeah, so you have like ownership entities. Obviously, you've got the REITs like Park Hotels and Resorts and others that own the real estate. So this is, as you said, like an asset-light, franchised, management tree-driven business with some owned hotels. There is some hotel exposure.
So what do they do with all the free cash flow every year? They got, most of that EBITDA goes down to the free cash flow line.
They have been returning capital, right? So they've got capital returns. And, there is real opportunity for growth within their business model. And a lot of that is international, a lot of conversions, a lot of conversions from other assets that fit very well under their brand flags. And they have also been launching some new brands as well in kind of that lifestyle category.
How many brands do they have right now?
So where are they now? I know Marriott's 31. I'm trying to remember what Hilton's count is right now.
So that's all those 31. Is that just slicing and dicing the market?
Yeah, it is. I think overall, if you slice the market segment-wise, Hyatt and Marriott are more prominent in the luxury highest end. Hilton has some luxury, but it's also got a very solid kind of mid-scale limited service portfolio. And so what you tend to see is that in this environment, luxury upscale tends to outperforming. And the limited service is somewhat weaker, partly because that's where you've got the government travel, you've got the transient independent business travel. But stuff like leisure, group, luxury, particularly international markets, UAE, Europe, non-China, Asia, all have been really quite strong.
I wonder, Brian, I know you don't cover Airbnb as a company, but do you ever see any correlation between the performance of Airbnb and a Hilton or Marriott? Because I'm sure in markets where Airbnb is not allowed, like New York City, for instance, Hilton benefits.
Yeah, I tend to think of the OTAs, the Airbnbs of the world, as being a factor with respect to both Las Vegas lodging, particularly in kind of the value-conscious consumer limited service. You've got some extra inventory there where it's good for that kind of last-minute inventory management. But the big focus of Hilton, Marriott, Hyatt has been the loyalty programs and the strong correlation between loyalty members and kind of booking directly. So there's that aspect as well.
The Walt Disney Company called out in their theme park business some weakness on inbound international travel. Are the hotels seeing that as well?
There is some of that. Some of that's from Canada, tariff related. I think kind of globally, the weaker areas maybe are inbound U.S. travel, U.S. government travel. China's kind of flat. The strong areas are all the other categories we talked about, luxury, group travel.
I always say to my Canadian friends, the first time it drops like below 20 degrees or 10 degrees in like November, you guys are booking your flights down to Florida. Let's be honest.
You'll sing a different tune, right?
You'll sing a different tune.
Brian, how exposed are the Hiltons and the Marriotts of the world to, the whole credit card debate? The president wanting to cap interest rates to 10% on credit card companies, and that putting at risk all these reward credit cards programs.
It's a consideration partly because a big part of that franchise fee line you see for Hilton and Marriott is actually fees from co-branded credit cards. That's actually a big kind of fee source. So all else being the same, the royalty rates and the level of credit card activity are somewhat of a driver for these franchise fees, these I should say, co-branded credit card license fees, which kind of find their way into the franchise fee line. So it is important.